It won't. The market is not like a set in stone, you know, distribution. No, it doesn't move like that. You know what I mean? It changes. It really changes. It morphs all the time, but it still respect the sequence. So here we have a classic, you know, sequence number one, or at least variation number one of the sequence. Um, right here. Oh my God, this is even a better example. So right here, you have that again. Right here, we got here. You have your grab of liquidity, displacement. What do we have here? A great example of, even if you tap into the imbalance, you have to keep in mind reasons, potential reasons that the market may not respect your imbalance. We tapped into your imbalance once, we came back, tapped into the second imbalance, came back, tapped into the third imbalance before giving us the second term, the long term low. You always have to keep that in mind. All right. Again, same sequence, no difference. All right. And here we are dealing with what? Okay, let me just delete all these fucking arrows. We're going to dissect this particular example in itself. And again, I don't even have a sense of daily bias at this point. I'm on a 15-minute chart and I'm just looking for ICT signatures. That's how I'm backtesting it for now for you guys. Or at least, you know, hindsight backtesting it. And you're going to do the backtest yourself on your chart. Right. So let's watch this example, right? Let me just go back here all the way to this point right there. Boom. Okay. So you have what here? ICT, right? So we got here, boom, we form the breaker or the liquidity pool or whatever. We grab the liquidity and you have your displacement. The first place where you wait for a trade, as per ICT, is your area of imbalance. There is nothing wrong with that. You take your trade here, you had your second imbalance. All right? But when you do that, there are questions you need to ask yourself. Is there any reasons that the market may want to try to come back and tap something above? Or has the market left anything behind this order block or above this order block, since we are talking about a bearish move here, above this order block that might stop me out? Of course they did. We have one reason. Well, on top of your, aside from your actual, you know, your first imbalance as per ICT, you have one reason here. You have a whole ass reason here. All right. Now I know ICT tells you that, oh, you check the imbalance and you put your stop loss all the way up here. Man, fuck no. I don't put my stop loss up here. I'm sorry, ICT. I don't mean to disrespect you, but that shit is crazy. I ain't doing that shit. I'm not. Put my stop loss here, 22. Split this in three, 1%. Split this in three. 0.33, 0.33, 0.33. Whichever the case may be, hey, it is what it is. You get tapped in, you have your profit. Now, of course, at this point, it is completely fair for you to think, hey man, look, this is your, you know, this was your intermediate term high, and here you got a second long term low. Now, this is where you have to be pragmatic with your approach with the market. At this point, this is where you want to understand, should I say, your daily bias. You know what I mean? If we are here, what is the market trying to achieve? Are we trying to grab this sell side liquidity, or is the market trying to go to the upside? Because if we are trying to grab the sell side liquidity, then yeah, sure, this market should have gone down by now. But if we are making all these stuff happening right here, maybe you need to look into your bias and be very careful with how you thread with this area. But anyway, you got a nice trade here that gave you your long-term low. Aside for this, like a second long-term low. And what do you see here? You see a beautiful, hold on. You see a beautiful second displacement. I told you what, in this sequence, what I want to see as soon as you get tapped into the imbalance or the order block that's residing, whatever, as soon as you get tapped into the imbalance, I want to see a displacement. I'm not here to care about some, choppy moves. No, displacement. I see this, I'm happy. Boom, we get here. But now I know we left this guy here. Whole ass imbalance. So I wouldn't be surprised if the market comes back here. But again, earlier I said, soon as we get our intermediate term high, I don't want the market to come back here or above this. But in this case, it's kind of different because we have reasons to come back here. So you have to take that in account. So at this point, what I don't want the market to break is this high. You have to be pragmatic and loose with the market. At least that's what I've learned. All right. So we are here. I take my profit as soon as I see something, whatever. Anyway, from this point, I would have gotten 1 to 3 anyway, I believe, because this is a good 1 to 3 at this point. Because if you target this candle, that's how I target it. So if you target the start of this candle, you have a clear 1 to 3. So I would have been out. My partials would have been out, and my stop loss would have been our break even at this point. So as soon as I see this, now I'm waiting for my trade at this point. Then I'm waiting for my trade at this point. And if it fails, well, I guess we're taking out the highs. That's it. One thing is sure is I'm not losing all my money. That's for sure. So that's pretty much it. So that's an example. I hope that makes sense. So if you want to really look at it in a sequence form, you're going to have your long-term low in for the time being. Before you get this delivery, this would be your intermediate term high and your second long-term low. All right. After this, the market feels like, well, I have some things that I left up here that I want to go and grabs it, gives you an intermediate term high, grab an intermediate term low, fails this intermediate term high again, taps into this imbalance, and now gives you a long-term intermediate term low. So initially, if you really ignore all the mess that happened here, this right here is your sequence. Hold on. This right here is your sequence, and we draw. If you take the time, if you're willing to ignore all the mess, but we are not perfect, probably I wouldn't ignore all the mess neither, you know what I mean? But essentially, that's the development of the sequence. It's real. It's there. It's not. You can't make this up really. When you look at the market from a design perspective, man, you really start to believe that this shit is manipulated as fuck, and whoever programmed this shit is amazing, because this can't be human. This can't be human made. Like, I don't believe that 10 million of people are just out there and be precise that, oh, okay, at this point we're going to make this signature by buying and selling this way. Man, fuck no. Humans are not that coordinated. We kill each other over bread. So what else do we have? Can we find another example? Well, essentially we have an example here. Again, this is a perfect example to show that it doesn't always have to look like the way ICT showed it in his video. It can deliver it completely different, but it's still the same goddamn thing. You have this right here. We go up, displacement to the downside, right there. Doesn't that look like ICT, right? Where do we test? We left an imbalance here, the low, first area of test, second area of test. We came back and tested the second area of test, and we dropped. It's completely free for you to look at it also from this perspective. We grabbed liquidity, we had a displacement to the downside, we came back and tested the imbalance left behind, give you your intermediate term high, and you have your intermediate term low right here. And after that your second long-term low with a displacement again. All right. And after that, you are due to what? You are due to a retest either of this point of this point or this point, and you got it to continue to the downside. Same, pretty much the same thing. It's just this time, where is that drawing again? Where did I put the drawing? Oh my god. Only difference is that this time the delivery was a little bit more elongated than the example that we saw on a 1 hour. But what did I say earlier? That you are likely to see variation number one on lower time frame and happening rapidly compared to what we saw on the 1 hour, which was more of a daily distribution to go in towards a daily an old daily or weekly low. All right, so that involves a lot more liquidity and a lot more, should I say, price delivery to accomplish what it's trying to accomplish. Let's find another example. I'm not seeing much here. I'm not really seeing much here. I mean, is this that? I don't think that is. I'm not going to pretend that I know what this is, but it delivered it completely differently. So let's find something else. Here, another example. You have liquidity pool. We go up, we drop. All right. You look at the imbalance. You ask yourself, if I take a trade here, even if I take a trade here, is there any other reason above this imbalance that may make the market, stop me out? Of course there is. There is an imbalance up here. This is where you target. Oh, you can target this. You're not wrong for targeting this, by the way. You wouldn't be wrong. As per ICT, that's what you're supposed to do. But if you get stopped out, you need to know why you got stopped out. And you shouldn't be afraid to try the second point. If you got stopped out, that just means this was your long-term high, your long-term low. We are going for an intermediate term high. Your intermediate term high hasn't been formed just yet, especially if this long-term low hasn't been broken. All right? So you take your trade here and you have what? Displacement, strong displacement, just like I love it. All right? And that's it. You have your displacement, you get a retest of what? What did I say earlier that you're going to get your retest on? You get your retest on the long-term low, which is here, right there. You push to the downside, and then after that, the market can do whatever the fuck it wants. Again, same thing, same sequence, delivered completely differently. Happens all the time, man. Happens all the fucking time. And obviously, if you couple it with your daily bias, you're going to have a much stronger, how can I say it, a much stronger sense of direction than doing it this way. Here's another perfect example. You have your breaker here, right? The grab of liquidity, displacement number one, all right? We come back to take out, well, I don't know if you can see it. I can't zoom because I'm drawing, but I don't know if you can see this inefficiency on this candle. So this is what the market comes back to get. We get it. Now you have your intermediate term low, your long-term high. So after the first displacement, you had long-term low, long-term high. In between the two, you want to see a long-term, an intermediate term low, and an intermediate term high. No, sorry. In between these two, you want to see an intermediate term low and a long term low. However, you are aware that the market may deliver you with an intermediate term high, which is what you got here. Intermediate term high, retest. Normally the retest should have been all the way here, but hey, it's the market, right? You have a retest right here, which gives you now all the little short-term highs and short-term lows that ICT said in the video. And then what? You have a continuation. This is a beautiful variation, second variation of the sequence. All right. Right after that, what do you get? This was your first long-term high. You get your second long-term high. After that, you get a retest of the first long-term high. continue to the upside. Just beautiful stuff, man. Can't make this up, bro. Can't make this up. Is there any other example? Even this one, you can consider it if you want to. Shit, I mean, I won't personally, but I'm just saying, it's just there, right? Here, came down, grab of liquidity, right here. Okay, this was your liquidity pool. If you look closely, you're going to see double highs here. Grab of liquidity, withdraw. Okay, displacement. What did we leave? What did we leave? Sorry, imbalance. We tap into it. Second displacement gives us straight up. Well, it's not really straight. It gave us like an intermediate term low here because it came back into this imbalance. So let me do this drawing again. So again, right here, grab of liquidity, we come down, enforce. All right, you get an intermediate term high because of this imbalance right here. The intermediate term high gives you an intermediate term low and comes back up here because it has a reason to. There is an imbalance. It has a reason to come back here. Hence why you have an intermediate term low as per ICT. Taps into the reason. As long as we don't break this intermediate term high, you're completely fine. Taps this, and what do you see? Second displacement. I mean, a displacement to the downside. All right, second displacement, and after that, what do we test? I said to you that you are likely to test the long-term low or the intermediate term low. What did we test? The intermediate term low, and we continued downwards towards 2 standard deviation. Boom. It's the same thing. It just delivers in different ways. I can't really show you an example on forex because I don't trade the shit. If I was trading forex, I would have shown you guys, but I really do not trade forex. I despise it, and yeah, I don't think I would be of any help if you are trading forex, unfortunately. But when it comes to futures, man, I've studied this market for such a long time that, you know, and you will get it too. It's not as if as I'm skimming through the chart, I see multiple examples. By the way, don't think I don't see it. You have an example here, and you have a perfect example of a failure right here. The reason why I don't take the trade is mainly because they are quite too fuzzy, and I don't want to go all the way down to the 5 minute because we're already in January, and I don't want trading view to, you know, just toss me to the beginning of the chart. No, sorry, to the end of the chart, current day of the chart and shit. That would piss me off. You have a good example here, and it executed that perfectly. This entire one is really a higher time frame one, like, but to be honest, this entire one I wouldn't have treated it like this. This entire one is more of a, I would have used the Wyckoff situation here instead of an ICT concept, if I'm being honest. You know, this is pure Wyckoff to me. A whole ass accumulate. Actually, I did trade this on S&P. Yes, I did trade this on S&P based on Wyckoff. I did trade this one on S&P. I think I lost money somewhere here on S&P, but I caught the bottom right here. I caught this. No, sorry, I did not catch the bottom. This is what, yeah, I entered at some point here on S&P, the equivalent. This is where I took my trade, and I rode it all the way to the buy side liquidity. That was it, just based on Wyckoff, nothing to do with ICT at that point. But you could have traded this with ICT as well. So anyway, I hope the example suits you. Here is one example as well. I remember this trade. I took this trade as well. This was a nice trade, man. This was from back in January, exactly, the 20th of January. This was a beautiful trade, man. I miss taking like all these swing long ass trades. Ugh, bro. Anyway, so for the last example, you have your breaker right here, grab of liquidity, displacement. Where do we go? Imbalance. Boom. Intermediate term high. From the intermediate term high, we have straight away a long-term low. So, is there any reason for the market to come all the way back up? Of course there is. Where is the reason? We left a huge imbalance up here. The market came and tapped this and then dropped. Same thing, man. Same thing. You just have to be ready for it. You just have to be ready for it. Really, that's all there is to it. Really, that's all there is. So, and even if you are not ready for the market to come back up here, you can anticipate this. All you have to do is every time the market gives you a displacement, keep in mind to mark reasons for the market to come back. Even if you got tapped in and you got a displacement, because you don't control the market, you can only think of the probabilities. What are the probabilities that the market rejects the imbalance with a heavy impulse? Well, it's probably very high. All right, it's probably very high, but it doesn't mean that it's going to keep going down forever. So if we hit the imbalance, is there any other reason for the market to come above the imbalance? Well, you damn right there is. Look at this shit right here. Did not even test it out properly, and it did not even go all the way up. But at this point, really, the minute you break this intermediate term high, I personally start, to think that the market is going to reverse. But if I get another break of structure, then I'm willing to enter in a trade and continue. That just means, okay, the market may have broken the intermediate term high, but we never broke the long term high. So it could still be fair to think about, going down, since we went back into the intermediate term range. All right. There is a perfect example on S&P that happened to me. I don't know when it was. I'm going to show you. I hope I remember where it was. Was it this one? Yes, it was this one. So here's an example of where you have a failure, where the market takes out the long-term high, okay? And at this point, you would think the market is trying to reverse and change direction and continue bullish. But look at that. I remember very well. Let's look at it on the 15-minute probably. This is the last example, and then I'm going to stop the video because I feel like I've been at this a little bit too long. So I think it was please let me have access to the 5 minute. Thank you. So I remember this day because, just so you know, from a market market profile perspective, there is a naked POC sitting here. Just keep that in mind, right? And I'm taking my trade literally at this point. Now, here's what saved me. Whenever, because in auction market theory, taking trades straight on the naked POC is considered to be like aggressive trading. So because I like doing that, because that's where you get like heavy volume or whatnot, sometimes it consolidates there, but when there is volume and when there is people, like a lot of participant, you may see heavy reactions there. So I always have a 10-point rule when I take a trade from the POC, and I always take it as a much minimal lot size than usual. All right, so I take the trade here, and as I take the trade, I see the ICT thing unfolding. All right, now let's go back on a 15-minute, and I think to myself, well, we have all these areas of imbalances. I'm not about to look at, take trades at every of this area. I'm going to the 30-minute or the 1 hour to delineate my areas. So we have this area right there, okay, as an imbalance. If I take a trade, as long as we have an imbalance here, well, I'm happy to believe that my trade is fine. I closed the chart and I went on by my business. I was not looking at the chart. Towards the end of the day, as the ICT thing is doing it, as ICT signature is doing its thing, as you can see, we have a intermediate term high here or whatnot. I come back to the chart and I see that the market has literally taken out this. Now, the minute I noticed that, I swear, I promise on everything, it did not even take about, it wasn't even 2 minutes later, this candle happened. This is the part where sometimes you're going to have to trade with luck. This was pure luck. I did not understand. Like, I knew we were going to have a move, but when we stopped, when I got stopped out here, I thought the market was going to reverse. But again, this is why I said paying attention to the way ICT talks can be very beneficial. Let's play again the last thing that he said.
Proven inaccurate. Idea is probably been proven inaccurate, but you have to be by the likelihood that your idea is probably been proven inaccurate, but you have to be receptive.
Probably been proven inaccurate, which means what? Which means the same way the market takes out the long-term high, the same way it could mean that your analysis is inaccurate and the market is trying to go to the other side. The same way it could just mean that, hey, there was an anomaly, and I don't know, the market decided to come and scare these people off before continuing into your initial daily bias that you had. All right, probability is all a game of probability. Yeah, I may talk about the sequence. Yeah, it may sound like when you hear people say that, oh, it happens every time, it happens every time. Yeah, it's true. At face value, it's true. But really, when you're live, it's like anything can happen. When you look at it on hindsight, it happens every time. But when you're live, anything can happen, and you have to be ready, and you have to put all these different techniques in. It has to be in your keychain. It has to be in your tools to help you navigate those trades very well. That's why Dominic technique of 1 to 3 is probably one of the best technique from this ICT, because ICT tells you, oh, you can target 1.5 standard deviation. Man, 1 to 3, you are guaranteed to get a 1 to 3 after an ICT signature. Guaranteed. Absolutely guaranteed. Anyway, I'm not going to make this too long. I hope I made sense. And from here, if there is anything else, if there is anything that I explained wrong, please let me know. This is too long already, but fuck it. I already did it. And I hope it's going to be helpful. If there is anything that I said that you think I said wrong and you can correct me on it, please, guys, make sure or feel free to do so. Because as I said earlier, as I'm doing these videos, it also helps me ingrain those information even better into my brain. So I could be wrong at some point, and if I am, feel free to let me know. As I said, I am not trying to teach anyone. I'm not a guru. We are just a group study, and we study together. So if you have an insight that I don't, or if you've understood something that I haven't, please let me know, and let's move forward together. Hope you have a nice weekend. Peace.